right, Adobe currently at 350 out and about. Um, that's a price. We see a price graph intraday. Let's look at 5-year price. A little up, a little down. Now, when we do a stock analysis, we want to answer three basic questions. We want to see, is it a great company? Can we get it for a great price? And can we reliably predict it for the future? Now, when taking into account the first question, is it a great business? One thing that I find very important to look at is its liquidity position. And if you hear liquidity, think cash. The reason for this is cash allows a company to invest in themselves, to buy other businesses. If the business is going slow, they can use some cash to make sure they stay afloat, they don't go bankrupt. So it's a great starting point to assess whether a business is great or not. If you look at the cash side, you also want to look at the debt side. And the debt is kind of the conscience of the company. They can increase their cash, but if the amount of cash that has been created is equal to the amount of debt that has been taken on, it's a net zero game. So you wanna check if both are in relation to one another. And a quick way to do this is if you go to the cash flow statement, the balance sheet, and we look at their you want to look at their short-term cash, and I think short-term investments. This could be treasury bills. You want to take those into account. It's about 8,000, and then if we scroll down a bit, we want to look at short-term debt, which is about 1,500. So they have way more cash than that they have short-term debt. The reason why we look at short-term debt is because you have good debt and you have bad debt, and bad debt is usually the short-term kind. The interest rates could be lower, but they're also due earlier. So you want to be sure that they can pay the debt that is due the earliest. And long-term debt, a lot of the time could be capital leases. And a good form of debt is to have a mortgage or to have a lease on a building. So we are a little bit more lenient on that side. Okay, so it meets our first check for the liquidity. Next up, we want to take a look at cash flow and whether the business is operationally efficient. Now, what does operationally efficient entail? We want to make sure that from everything they sell, they can keep a high amount of cash. And we don't look at EBITDA. The reason why EBITDA is something that's invented by private equity, and it's only there to sell a business for a higher multiple, but it doesn't tell you actually anything about the quality of the business, or it can tell you something, but it's very easy to manipulate. So whenever you hear EBITDA, think bullshit earnings. You want to look at cash. Cash is what you can actually use as an investor. Cash is something that the business can actually use. So that's what we want to take a look at. And if you don't want to dive too deep in all the cash flow statements, you can look at the margins. And Adobe is a perfect case of why you want a software company, because they have very, very high gross margins. 90% means that on every $10 that they sell, they get to keep 9. That's a really, really high number. We'll be looking at more stocks today. Keep in mind, 90% gross margins for Adobe, for a software company, that's very, very good. And the reason why this is very good, if you have let's say you have a factory, you need to pay for the raw materials, you need to pay for the electricity, you need to pay for all the labor. And with every factory that you add, you also increase your cost base. Now, if you have a software product, you can have the same piece of software and you could sell it to 20 different companies without having to increase your cost base at all. And that's why their gross margins are very, very high. Now, gross margins do not yet give you cash. For that, you want to look at the net margin, which is about 25% or 26%, which is still relatively high. And if we want to take a look at their cash flow, this is where you can see the cash actually coming in year to year to year. And we want to see this number grow. Ideally, you have a growing cash flow. It started out in, 2020, 2021, just under 7,000, 7,400. Then it dipped a little bit, and then it grew. It's relatively stable. Capital expenditure is their expenditure in increasing their production, which is, for a software company, it doesn't need to be very high. So the cash flow is relatively stable. Now, if we increase the periods that we're looking at, and this goes all the way back to 2015. Then we see a massive growth, but over the last 4 years, this growth has slowed down. Ideally, you want a stable free cash flow and a growing free cash flow. The free cash flow is very stable. We don't see any negative numbers. We don't see a high variance. Growth used to be there, but right now it's stable. Another thing we want to look at is their increase in revenue. Now, again, we look at the past 10 years. It started out at 5,000 and it is more than 4 times higher, more than 4 times higher, 21,000. Now, this is very good growth. And you see that the growth, that both their revenue is very stable and that the growth is there. The last few years, it has slowed down, which is not a strange thing. Their revenue, this is in million, so this is $21 billion in revenue. As a company grows more and more and more, it grows bigger and bigger and bigger. It becomes harder to keep that exponential growth curve in there. So this is a little bit of the growth is there, but it's slowing down. And if we take a look at our little graph, it's not actually too bad. Over the 5-year average, it's still about 14%. And we saw that on the September 11th, they're going to release their new earnings. I'm very interested if they can continue their revenue growth for the first 2 quarters of 2025, as well as continue their free cash flow growth, or rather pick up their free cash flow growth again. You can see that the 5-year average was around 11%, but their 3-year average has significantly decreased. And on the revenue growth side, you see that the 5-year average is higher than the 3-year average, which shows that growth is slowing down. Then what you want to look at next is what can they do with their cash? Can they invest it against higher returns than you yourself can invest it in the stock market? Now, I aim at least 15% return. So I want to see a higher than 15% return on my cash. And they don't show that. They have 14.42%. Last year, it was even worse. So we truly see a business that used to grow very, very rapidly. That's absolutely slowing down. Their cash situation has improved. No, it hasn't. Over the 5 years, it was higher than the last year. So they've spent some of their cash. But this is a healthy number to have. And what they do with that cash is they do buy back shares. Now, I always am happy to see share buybacks for a company that is slowing down growth, that has a lot of cash, and they want to invest it somewhere where they can get a good return, and they invest it in themselves, limiting the total amount of shares, therefore increasing your total share of the pie as a shareholder. So I see some good things, some bad things. I don't think it's a great business. It's just okay. It's not great. But price matters. So if we can get it for a cheap price, it could still be a worthy investment. So next up, we move on. Can we get it for a great price? Now, what makes up a great price? We've already decided that their growth is slowing down. They used to be a very high growth company. If they are a high growth company, you want to pay. You're willing to pay a higher multiple on their earnings, and that multiple is called the price to earnings, or PE ratio. And for Adobe, you're paying 41.5 times their earnings as a share price. And market average historically is about 15. This is more than twice as high for a company that has slowed down growth. On the face value of this, I already would say this is not cheap at all. Price to free cash flow for free cash flow, that is, it's growing, but it's not worth 30 times price to free cash flow. And another way you can kind of look at a business, whether it's overvalued, undervalued, or you're paying more or not, whether something is a great price, you want to get a yield that's higher than the interest rate, or that you could get if you just put your money in the bank and you take on no risk at all. So the no risk rate is relatively equal to what you could get if you buy US Treasury bills, or if you put your money in a high interest savings account. And right now that's higher than 4%. I'm not actually sure what I can get right now. In the US, it's a little higher. Over here in the I live in the Netherlands, it's a little bit a little bit lower. So 2.41 is higher, but you're taking on more risk. So I would want a higher margin of safety. I would want to be able to get paid more and therefore have a lower share price for it to be a good investment. Right now, you're taking on quite a bit of risk. You're paying for growth that's not there. So on the face value of it, it's not cheap. It's not cheap at all. They don't pay a dividend, so there's no cash flow that you can reinvest yourself. So I would say it's not cheap. It's not a great business. And then the last price is the predictability. It's very, very stable. It has shown very stable revenues, even though slow growth is slowing down. It has shown very stable cash flow generation. And it's also very clear what they do with their cash. They have low amount of debt, they have high amount of cash, they buy back shares. So I would say predictability is great. For me, for this to be an interesting investment, the share price would have to, well, almost half. It has to be closer to 15. Um, it's not there right now. I don't see it going there anytime soon, maybe after the earnings. Um, but now I want to take a look at another stock that's closely related to Adobe, because Adobe dominates with their product line, or they used to dominate the entire creator market. Everybody who does anything with video, with photo, with audio, they all use the Adobe suite. Adobe is very smart to target students, and whenever they get you locked in, they grab you by the balls and they never let you go. So everybody keeps buying Adobe. They keep buying into their ecosystem. Everybody gets used to using Adobe. And I've worked in a big software company, and everybody that was used to using Adobe, they didn't want to switch. They didn't want to switch at all. So if they have a very good moat, it makes them a very strong brand. It makes them a very strong business. You could be willing to pay a little bit more for that. I think where the times are changing quite fast with AI and all the new tools that are coming out. So I think that moat, I value it a little less. And one of those new players is Figma, and it has recently IPO'd. So there's not a big stock chart to look out for. It IPO'd a little before August 2025. I'm not entirely sure when they IPO'd. Let's look it up. IPO Figma. Mm, This was the 31st of July. I'm not entirely sure when they IPO'd, but looking at all the headlines, it wasn't very successful. And we already see quite a significant drop. But again, let's take a look at it from the basic three questions. Are we buying a great business? Are we paying a great price? And can we reliably predict it for the future? Now, first up, is it a great business? We want to look at their balance sheet, see how much cash they have on hand, about 1,500 cash and short-term investments. If we set that off to their short-term debt, their cash position is looking nicely. If we look at our income, the only 2 years we can take a look at. Let's see if we can get some more data. If we look at the quarters, it has, can we say it has doubled over 2 years? Less than 2 years. Less than 2 years, it has doubled. That's quite good growth. It's not exponential, but this is something that you would be willing to pay a higher multiple for. Now, if we look at their cash flow, are they cash flow positive? They used to be cash flow negative, but they've turned it around into cash flow positive business. Now, to say whether or not this is stable, I think that's too early to call. But you can't tell there's growth, both in they're going from -20 to +60 in only 4 quarters. They've recently announced their earnings, so this is quite recent data. So there's nothing being added to this. Okay, so I think from this perspective, it's looking okay. Are they operationally efficient? Again, this is a software business, so gross margins are very high, lower than Adobe, but the amount that they can keep in cash is a lot lower. For a growth business, it's not too difficult. Or we can explain why this is extremely negative. They probably reinvest all this money back into themselves so they can keep growing the business. Yeah, these graphs, they're not yet very informational. We have very few amount of data points. We do see revenue growth Free cash flow growth is not too great, but this is only up till 2024. The 2025 quarter data is not yet in here, which was positive. Return on invested capital is still negative, so yeah, you see growth, but irrelevant. Their most recent return on invested capital still minus 60%. Cash to debt very high for a growth business. You'd like to see this. They need to be able to pay for their expansion, and with a big pile of cash, that's relatively easy to do. So this is what we like to see. They also hand out shares. Ideally, I want to see share buybacks, but for a business that's still very young, that has just IPO'd, that's still growing, them handing out more shares in order to get more cash without taking on debt, which they seem to do, is a great business strategy. Now, if we look at what they actually do, and let's see what their recent earnings calls, how the management talks about their business. They make tools and product teams for product teams and designers. They're also a subscription-based business model, and they earn money through licenses and product offerings, very similar to Adobe. I think the Adobe suite is a lot bigger. The Figma suite is a lot smaller. As user base can grow, they can add more products to their business line. They have a strong community in product innovation. They hosted 10,000 community members at their content conference. They build loyalty and brand strength. Modifying payload. Yeah, they're already increasing their capabilities by doing mergers and acquisitions for Modify and Payload. They try to do basically what Adobe did or still does, creating community by making sure people buy into the brand and stick to it. And then they can keep selling their licenses, maybe increase the price a few times, and then Figma basically becomes Adobe 2.0. Their growth ability, their revenue grew 41% year over year, reaching 250 million. Now, this is still relatively small if we compare it to Adobe, which had 21 billion. 250 million is only a fraction of that. They launched 4 new products, doubling their offerings. That's quite significant. Their commitment to evolving customer needs. They're focused on AI. Everybody's talking about AI. May reduce margins because they need to make investments, but positions them for future growth. Now, Adobe is also investing in AI, so to me, this is not really a defining characteristic for Figma, something that sets them apart. It is not. Future expectations. Management emphasizes long-term growth through AI investments. They believe AI will transform software development workflows. I do agree with that statement. Figma's revenue growth. They're investing in blah, blah, blah. Community engagement is robust. Yeah. I think it's too early to call it a great business. They're not yet profitable. If we look at their net margins, negative EBITDA, again, bullshit earnings, but negative, so not too great. They do have a lot of cash, so there's room for growth. In my mind, it's a little early to buy into it. The price has dropped significantly, but it's very hard to value currently. What are we paying? Net income, revenue streams. Yeah, revenue is positive. Earnings per share was negative. Look at it from a yearly perspective. I think 2024 must have been a negative year, and they've already this quarter seemed to turn it around. And I do find that to be interesting because they've gone from a negative earnings per share to basically already in the last quarter of 2024 to a positive earnings per share, except it went back down to 0. Yeah, I think this is something that you can put on your watch list, take a look at every now and then. Right now, it doesn't scream that it's very investable to me. Is it a great business? I don't think so yet. It's very hard to price effectively, so I can't say whether it's a great price or not. And predicting it reliably for the future is also very hard with a small business. Growth could slow down. The whole AI boom could produce an entirely new player taking away market share. Adobe is still the big boy to beat. They are closing in, but they're not yet in a position that they can confidently say they're beating Adobe. Uh, I still think Adobe has a stronger market position than Figma, and that gives them more avenue and some maneuverability, even though bigger companies are less maneuverable than small ones. So to me, this would be something to look out to, look for, yeah, keep on your watch list, take a look at it every now and then, maybe at the end of the year, see where it's going. Right now, it's too early to call, but interesting to look at. And there is another player in town, so Adobe, watch out.